If you're running a small business in Canada, you've definitely faced this question. You need new equipment to grow, but do you lease it or do you buy it? And let me tell you, the answer goes way beyond just the price tag. It can totally change your cash flow and, more importantly, your tax bill. See, this isn't just about a monthly payment versus one big purchase. This is a huge financial fork in the road that decides how and when you get to write off that cost. And right now, things are a little crazy because of some new and very temporary government rules that have completely changed the game. The stakes? They've never been higher. So here's how we're going to break it all down. First, we'll look at this simple path, leasing. Then we'll get into the weeds of the traditional system for buying. After that, we're going to talk about the new rules that are shaking everything up. And finally, we'll pull it all together into a clear framework so you can make the absolute best call for your business. All right, first up, leasing. From a tax and accounting perspective, this is usually the most straightforward option. It's all about getting that immediate relief and just keeping things simple. Here it is, the #1 reason people lease. Those lease payments are treated just like your rent or your utility bills. You pay it, you deduct the whole thing, it's that simple. What does that mean? It means an instant reduction in your taxable income for that year. No fuss. But, and this is a really important detail, you gotta know that the Canada Revenue Agency sees two different kinds of leases. An operating lease, that's the one we're talking about, is like plain old renting. It's just an expense. A capital lease, though, is more like a rent-to-own deal. The CRA actually treats that like you're buying the thing over time. So for our purposes today, we're really focused on the power of a true operating lease. So what are the real tangible perks here? Well, you get to deduct every penny of your payments, sure, but you also don't get hit with a massive upfront sales tax bill. Instead, you just pay it bit by bit with each payment. That leaves so much more cash in your account for the important stuff, like payroll and inventory. Plus, you get to completely sidestep those complicated depreciation calculations, and your monthly costs are predictable, which makes budgeting way, way easier. So it makes perfect sense, right? If you're getting equipment that goes out of date really fast, think about computers or software, or if your #1 goal is to save on taxes right now and protect your cash flow, leasing is almost always going to be the smart play. It's just like FinCap says, it's all about tax flexibility and immediate relief. Okay, so now let's flip the coin over and talk about the other side, buying. This is the path you take when you want long-term ownership. And, you guessed it, it has its own special tax system. So, when you buy a major piece of equipment for your business, you can't just write off the entire price tag in year one. Nope. Instead, you have to use something called the Capital Cost Allowance, or CCA. Just think of it as Canada's official system for tax depreciation. It's designed to let you spread out that tax deduction over the useful life of the asset. It basically works in 3 steps. First, you have to figure out which class the CRA has put your asset into. Each class has its own rate. Second, you just apply that percentage to calculate your deduction for the year. And third, and this one's a big one to remember, there's the half-year rule. It means that in the first year you own the asset, you can usually only claim a deduction on half its cost. It kind of slows down your write-off right at the start. And here are some of the most common classes you'll probably run into. You can see stuff like office furniture is in Class 8, and you get to write off 20% a year. A delivery van, that's Class 10, gets a 30% write-off. But look at computer equipment in Class 50. It gets a whopping 55% rate, and that's because the government knows that tech becomes obsolete super fast. So yeah, whether it's shelving for your new warehouse or a new truck for making deliveries, everything you buy falls into one of these CCA classes. And that means they all follow this same system of gradual write-offs, year after year. Okay, now this is where you really need to lean in, because this is where everything changes. To get businesses investing again, the federal government brought in some temporary new rules that completely supercharge the tax deductions you can get when you buy. These rules have one goal: to get businesses just like yours spending money and growing their operations. But here's the big catch. The keyword is temporary. There are hard deadlines on these programs, which is why it's so critical to understand them right now. The first huge number you need to burn into your brain is $1.5 million. And believe me, for a lot of businesses, this number is an absolute game changer. So what does this actually mean? It means if your business qualifies, you can write off up to $1.5 million in capital purchases immediately in the first year. This rule lets you completely bypass the normal CCA rates and that annoying half-year rule. But you have to move fast because the deadlines are right around the corner. Oh, and here's a pro tip. If you spend more than $1.5 million, you should apply this full write-off to the assets that have the slowest depreciation rates. That way, you get the biggest possible tax benefit. I mean, just look at the difference here. It's night and day. Under the old rules, if you invested $1.5 million, you might have only gotten a deduction of a few $100,000 in year one. With this new immediate expensing, you get to deduct the entire $1.5 million. That is a massive difference to your taxable income and a huge boost for your cash flow. But wait, it doesn't even stop there, especially if you're planning on buying new tech. The next number you need to know is 100%. This is another incredible incentive, and this one is laser-focused on technology. If you're buying new laptops, new servers, or any networking gear, you can write off the entire cost right away. There's no cap. You just have to make sure you put it to use before 2027. This really is a golden opportunity to give your whole tech infrastructure a major upgrade. Whew. Okay, so on one hand, you've got leasing. It's simple, it's predictable, you get immediate deductions. On the other hand, you have buying, which has been temporarily supercharged with these insane new rules. So how do you possibly choose? Let's build a little framework to help you decide. Let's put these two head to head. With leasing, your number one priority is protecting your cash and keeping your expenses totally predictable. With buying, you're definitely tying up more money up front, but in return, you get to use that massive first-year tax shield from the new rules. And here's another key difference, your balance sheet. Leasing keeps the asset off your books, which can help your financial ratios. Buying, of course, adds it as an asset. So really, it boils down to your immediate needs versus your long-term goals. So, to make the right call, you've just got to ask yourself some honest questions. Is cash king in your business right now? If it is, leasing is probably your best friend. Do you plan on using this piece of equipment for its entire life? Then buying starts to look a lot more attractive. Is it tech that's going to be a paperweight in 2 years? Leasing helps you avoid getting stuck. And most importantly, is your business even eligible for these temporary tax incentives? And have you talked to your accountant? That last one is non-negotiable. At the end of the day, it all comes down to this one question. Are you playing the short game to protect your cash and stay flexible? Or are you playing the long game to build up your assets and take advantage of a once-in-a-lifetime temporary tax opportunity? There's no single right answer for every business. The best choice is the one that lines up perfectly with where your business is today and where you're trying to take it tomorrow.